everyone. Welcome back to the channel. In today's episode, I am talking charts with Caleb Franzen. Caleb is a trader and an economist, and he has a newsletter, a Substack that you can find. It's Cubic Analytics. It's one of my favorite Substacks that I subscribe to. Welcome to the show, Caleb. Thanks for joining me. Is there anything else that you want to let the people know that I may have left out?
Nah, man. Appreciate the intro. I know this has been a long time coming. I've been watching some of your YouTube videos, seeing you and Larry jam out hostile charts. So good to be here, man.
Cool. Yeah. So in this video, we're just going to kick things off. We're going to talk inflation. We'll talk commodities, talk growth stocks, interest rates. So a lot of good stuff. So let's just jump into it. All right. So the first thing I want to discuss today was the big CPI print. We got the July print. So that came in at 3.2%, which was, continues the trend of inflation heading lower, but we were slightly higher than last month. So what do you make of this, Caleb? I know you follow economic data a little bit more closely than I do. So I'm just wondering if your interpretation of this, a big thing that you've been discussing lately is this concept of disinflation. So just was interested in how you're thinking about this inflation number.
Yeah, man, this was probably one of the more nuanced inflation reports. And I kind of did this offhanded, facetious tweet earlier in the week saying that, we're not going to see disinflation in this report, but we're going to see disinflation in this report, right? Because on a headline basis, we saw a reacceleration of inflation on a year-over-year basis. But if you kind of dive into the nitty-gritty and you look at core CPI, if you look at median CPI, if you look at trimmed mean CPI, all of the main metrics that are alternative to the headline data are still showing disinflation, right? So the average component of the CPI is still decelerating on a year-over-year basis, aka the definition of disinflation, and so that was kind of what I was expecting to see, which is why I put off that kind of facetious tweet earlier in the week. And so I think one of the important things to note on the inflation piece is that median estimates were projecting for 3.3% year over year for the headline figure. And so we still came in below that, right? We came in right at 3.2%. And I think it was slightly below that. It was like 3.18 or 3.16. And then they just round up and call it 3.2. So, it's like, as you know, probably better than anyone else, but it's worth repeating is, the market is priced based on these expectations. And so it's all about the move or the result relative to those expectations is what creates the move, right? So initially we saw equities and risk assets kind of rip in response to that. And I think we saw maybe a little bit of some exit liquidity coming in the first 30 to 45 minutes of the market. And we've kind of been selling off since then. So a little bit of a reversal today in risk assets.
Yeah, that's why they often say don't trust the first move. So this morning had a nice pop. Looked like the market was going to have a really nice day after trending down the past few days. But we sold off. I think before I hopped on this call, we were about flat, heading into this, talk with Caleb. But it's pretty interesting, just the reaction, the initial reaction to inflation versus how we close the day. But as far as when we look under the hood, is there anything? Can you see this clearly? This breakdown of where inflation's at and where inflation isn't. I think it's pretty interesting when I look at this chart. Kind of what jumps off the page here, in particular, is just how gasoline and energy prices are way down there. And then you have, stuff like rent that's proven to be a little stickier. Restaurant meals. I think if I'm back in the States now, so I've been out to eat a few times and definitely noticed that one. So is there any big takeaways when you look at this breakdown and of where inflation is strongest and where it's a little bit weaker?
So let's start from the top and go to the bottom. We'll go through every single, no, I'm kidding. We won't go through every single component, but we will start from the top. So with respect to rents, that's still coming in hot, right? So if you look at the shelter component of CPI, which rent is a subcomponent of that came in at 7.7% year over year. And I think that was flat relative to the prior month. The important thing to note here is that owner's equivalent rent, how they measure this, is totally detached from the reality of what people are actually paying in terms of rents. And so, this metric sucks. It sucked when inflation was rising, and it sucks when inflation is falling as an accurate measurement of what people are actually paying there. And so the guys over at Wisdom Tree published data on this. They manage basically $100 billion in their funds. So, they have a full team of analysts diving into this data, looking at it. And all they do is they look at the CPI, they take out the shelter component, and they put in private market data. So you have stuff from Apartment List, you have stuff from Zillow, you have the Schiller, the Case-Shiller, National Home Price Index, so on and so forth. So they just take that out and they put in these alternative private market metrics. They leave everything else in the CPI the same. If you look at that data point on a year-over-year basis, CPI is 0.5% year over year, right? So this is shelter and rent is the primary driver. It's over 90% right now of what's causing inflation, right? So this is a really key thing to know. So if you want to know where that rental component, right now it's showing 8%. If you want to know where that's headed, look where rents are right now on a year-over-year basis in the actual market. Look where the National Home Price Index is on a year-over-year basis right now, and they're basically flat or contracting on a year-over-year basis. So that's where the rental component, the shelter component of CPI is going to be over the next 8 to 12 months. And that makes up 35% of headline CPI and over 40% of core. So this is one of the main pieces of my disinflationary outlook in the months ahead, for sure.
So the alternative private rent data that Wisdom Tree uses, is that leading what the government uses for their CPI calculations, or is it just entirely kind of different numbers? Basically, I'm asking is like could you foresee the government's official CPI measure of rent catching up to what we're seeing in alternative sources of inflation right now?
Absolutely. Absolutely. 100%. So, the Fed has even come out and acknowledged this in their own research, is that the Bureau of Labor Statistics measurement of shelter and owner's equivalent rent, it's survey data. It's not actual real data. They go to existing homeowners who live in a primary residence and they tell them, if you didn't live here and you rented it out to somebody, what would you rent it for? They pull that data and then they track it. This is how they're calculating the shelter component. So these are people who are living in their primary residence. They don't know what the hell they would rent it out for. They're totally detached from what's actually happening in the rental market because they're not renting the house out, right?
Yeah.
So it's crazy. So, even per the Fed's own research, the shelter component lags real private market data by 8 to 12 months.
Interesting.
Yeah.
And so we on the lower end of that spectrum, we did see that energy prices, I think it was just gasoline was down. Let me check again. I think it was 20%.
About 20%. Yep.
That down 20%. But the reason I point that out is just because I'm sure you've noticed it as well. A lot of traders have been pointing this out lately. We're starting to see an uptick in energy prices, which is filtering in to the strong performance we're seeing within energy stocks. But let's start things off by looking at crude. So this is
sure.
WTIC, and you can see, if this was a stock, this would be a pretty bullish setup. We can see it as this basing pattern. And everyone uses different indicators. I use the 10 and the 30 week to just kind of identify, a stock, or in this case, an asset's primary trend. And we're above those, and those are starting to turn higher. So this looks, pretty bullish, which to me suggests higher energy prices going forward. And I'd love to hear your take on that, and also just kind of your interpretation of what that could mean for inflation going forward. I know it's not as big of a piece of the pie or puzzle as rent, but I figured it has to have some effect.
It definitely has an effect, but it's important to kind of contextualize where we are on a year-over-year basis. First of all, you're spot on. This is bullish price structure. We're trading, I use the 200-day moving average cloud. So I combine the EMA and the SMA. We broke above that, I think, last week or a week and a half ago. So I said, look, tactically, structurally, I'll get a little bit more bullish on oil here. And let's see if we get the follow through, because I think this is important. If you look, let me say it this way. If you look at where the average price of crude oil was for the week ending on Tuesday, so we're recording this on Thursday, but if you go for the week ending on Tuesday, the average price of crude oil was down 12.5% year over year. And this is, with this massive run up that we've had, right? So basically, as it relates to inflation, I still see outright deflation from crude and energy and oil, probably for the next 1, 2, maybe 3 months. Let's just see how the price action unfolds. And I thought this was super important too, right? So if you look at the average monthly price of crude oil last August, it was $93.67. If you look at the average monthly price of crude oil in July of 2023, it was $76. So that means that crude oil this month, the average price, is going to need to gain 23% in order for it to be an unchanged year over year, right? Relative to last August. So that's a massive, run up in crude. And it's certainly possible. We've seen strong momentum already in the first, let's call it week and a half of the month. So let's see where it shakes out. But, a 23% gain in the month for crude oil is pretty phenomenal. And I think it's a bit of a reach. So, it's possible, but I'm not banking on that.
Interesting. Yeah, I guess one kind of counter argument to that, though, would be maybe the energy inflation doesn't manifest and show up, this month or next month. Maybe it's, further down the line. Maybe we start to see an uptick in maybe December, because you can see on this chart that energy was falling during this time. And if, energy, oil prices continue on the current trajectory we're on, will be above those late 2022 prices. So that would be something to watch
for sure
on my end. But everything, you said totally makes sense about inflation in the near term. So it doesn't seem like something we need to be concerned about just yet. But the markets are also forward looking, so it is right. worth thinking about.
100%, totally agree.
So it's similar to the chart we just showed on oil. We're always also starting to see pretty constructive bullish action for natural gas. So this is a chart I shared a few days ago, maybe last week. I can't remember exactly, but just pointed out that this big base was forming. Then we had this, kind of, if you want to call it a bull flag, just consolidation after that initial breakout. We've since broken out to that. We're up about 6.6% today on heavy volume. And so this is, looking constructive, and looks like natural gas prices could head higher as well. Actually looks even more bullish than the chart of oil I just shared. So yeah, I mean, I don't know if you had any thing to add on this. I'm assuming it's a, similar conversation of what we just said about oil as it relates to inflation. I think it's probably also applies to natural gas. But do you have anything to add on this one?
The thing I'll add is, I do these like weekly group calls and like Q&As basically with my premium members on Substack. So we actually have one later tonight. But 2 weeks ago, one of them asked me, "Hey, what do you think of BOIL right now?" Which is that 3x leverage nat gas ETF.
I was like, man, that one.
Yeah, exactly. And I was like, man, I wouldn't touch it. I got caught in a trade in that. I think it was earlier this year, like back in February or something. And I got stopped out. It was just before we had that like little V shape there in late February. And I got stopped out on that first initial V move. So, and then of course it ramps higher, but thank God I eventually got out of that. And so I told him, I was like, man, that thing's a widowmaker. Like maybe I just have PTSD from it, so I won't get involved. But I was like, it's up to you. It's like your risk reward. But personally, I wouldn't touch it. And now, we're seeing that gas just rip up. Like you're spot on. This structure looks great. I don't know if I'd be chasing it here, but I'm also the guy 2 weeks ago who was saying don't touch it. So
Yeah. I just one thing to point out before we move along in the presentation or whatever you want to call this. I just think it's funny, or it's worth pointing out that it was right around here, really, heading into last winter, where everyone was convinced that winter was coming for Europe, and Europe was going to freeze, and nat gas just basically went straight down, and that's maybe where it got the reputation of being a widowmaker for a lot of people, is that it was. So I think it was such a consensus trade that because of everything that was happening between Europe and Russia and all that, everyone was convinced that natural gas prices were going to moon, but it did the complete opposite. And now on a macro level, as far as it relates to like Ukraine or anything like that, I don't think a lot of people are really talking about natural gas in that way. But it's just interesting that this is, as soon as everyone's kind of stops caring about it and moves on, everyone was like interested in growth stocks and other assets to trade within the market. That's when natural gas puts on this bottom and starts to wake up. So kind of a interesting lesson about being a contrarian.
True.
So I mean, we covered the commodities, and I just the energy commodities. I just thought I'd share this chart. This is XLE. I just think it's not really a surprise based on what we've showed with the oil and natural gas charts, but pretty constructive action. And XLE, the energy sector ETF, and I know JC of All Star Charts has shared a version of this chart which compares XLE to tech. And so I think, like one thing that a lot of people are watching right now is just potential rotation out of tech sector and maybe communications, maybe consumer discretionary stocks into other areas of the market. And one area of the market that seems to be benefiting from that rotation so far has been energy stocks. And I don't know if you got anything to add on this one. I know we got another energy ETF to look at that you sent over.
The one thing I'll say on this is I was looking at some data. This was yesterday, so I don't know how it's changed as of yesterday in today's price action. But energy is one of the top 5 performers on a 1 month and a 3 month basis. The only other sector that's in the top 5 on a 1 month and 3 month basis is financials. And so these are 2 sectors that are going to be benefited from a rising interest rate environment, right? So pretty interesting to see that strength there in both energy and financials for sure.
Yeah, absolutely.
It seems like we have strong tailwinds right there. Structurally, it looks great. It's trending over those EMAs. They're sloping higher. In a lot of ways, what's not to like?
Yeah, definitely.
Yep.
And then, you speaking of energy, this is a chart that you sent over. The ticker on this one is PSCE. I don't know the name of it. I think it's a small cap energy ETF, and similar action to what we saw in XLE, broke that downtrend that it had been in for several months, maybe a little over a year. And it's looking pretty good. You can anything else you want to add to this chart? I see that you had it break the downtrend line, and it looks like it's potentially flipping some prior resistance in the support here.
Exactly. I think that the risk reward becomes extremely attractive on this if we re-enter that gray zone. It's certainly not promised. You could see kind of there's a candle or a wick that might have gotten briefly above that gray zone. Even if you start retesting that, probably just above $54 a share, that might be a solid level to start hunting for some entries, and then you cut the sucker if we fall below the gray zone. But I think if you're above that gray range, you could stay long.
Yeah, no, yeah, definitely echo what you said, and also kind of how I would think about, potentially trading a name like this is if you look at everything, if you go back and look at some of the charts we've shared already. So you got XLE, working in your favor. You got crude looking good. You got natural gas looking good. We don't have it in this presentation or whatever, but we don't have the XLE versus XLK, which shows some potential rotation out of tech into energy. So it's not just you don't just have to trade this chart on its own. You can kind of take into account the bigger picture, and there's a lot of positive signals for energy right now. For example, if this was maybe a growth tech stock, I'd have a little less confidence that support might hold, but I'd have I'd probably sleep better at night buying this one on the dip if it pulls back into support.
Yep, agreed.
Just has more things working in its favor. Speaking of a stock that could be a potential buy pulling back into support. So this was Consol Energy. This was a name you sent over. I've shared this on my Twitter before. I'm actually in this name. So this is CEIX. And what are you seeing here? So we had the breakout to, I think it hit new all-time highs. This one, because it kind of went public fairly recently. Or, no, I think I'm thinking of Warrior Met Coal. But anyways, go ahead.
Yeah, I mean, this structure looks great. It looks very similar to what happened with that breakout and flip in the breakout over resistance, in the beginning of last year. And, that was after the stock fell from basically 35 down to 17.5, right? So basically got cut in half, goes all the way back up to that resistance level from Q3, Q4 of 2021, rips higher, flips it into support, and then hits new year-to-date highs just continuously, right? And so very similar price action now. We were at 77.5. We fell all the way down to 47.50, and we just rip face right back to those, former highs, breaking above it. And I'd love, again, to see if we could flip this into support as well. So very similar to that PSCE chart that we were talking about, that risk reward becomes extremely attractive if we get back into that gray zone, and then you're long and strong until we fall below the gray zone. Yeah, absolutely. And for people who might be interested in trading coal stocks, I think one thing to point out is there's the coal ETF. They got rid of, I think, right around the bottom. And so I've been, I traded this one. I also had traded previously AMR, and I've shared charts of that on my Twitter. And I think
Everyone always gets excited about these growth stocks, but I think it needs to be pointed out that these coal stocks, when they get going, they can fly. So AMR from it was like the COVID crash, so it bottomed, I think, March 2020, and then I think rallied all the way up. I mean, don't quote me on this, but I think around November 2021, so right around when the market topped. But
Yep.
basically from when it bottomed to when it peaked, it rallied like 9,000%, and it had that huge run up. And Consol Energy was another coal stock that had a massive run up, multi-bagger on multi-bagger, but they actually consolidated and held those gains like relatively well. Yes, there was a pullback, but it didn't. It was different than what we saw in maybe your ARKs, where it had that parabolic rise and then followed that infographic where it goes from euphoria and then just like makes its way down to depression before it bottoms out. Like these coal stocks actually held up quite well, which is pretty bullish. And I don't know if we'll get anything like that because the moves off the COVID lows were quite extreme, but these things can really go when the tailwinds get in their favor, and we're starting to see a lot of reasons to like energy right here. So I'm glad you sent this one over.
It's hitting new all-time highs yesterday, right? And it's pulling back today. It's down just shy of 4%. So yeah, it's a pullback today, but as you correctly pointed out, these things have been monsters. And even when they've consolidated, they've held on to structure pretty damn well. And it's like, yeah, look at this chart that we're looking at right here. The thing basically rallied from January of 2022. It was around $17, $18 a share. And by August of that year, literally 7 months later, it was trading at 77. So I mean, we're talking about like at least a 500% gain, pretty much 450, 500% gain on this thing in 7 or 8 months. And it wasn't up only there, right? Like you could see that June price action basically falling from 57 all the way back down to 40. That doesn't feel good in the moment. You basically just gave up 25, 30% of your position in a matter of several weeks. But if you held tight onto that thing, because we didn't break down below that white level, you would have ridden this thing back up to 77. So it's a strong name. And I think unquestionably the biggest risk to the inflation story right now, just to tie it back into the macro side, is that commodities keep pushing higher, yields move higher, the Fed does higher for longer, the whole 9 yards. And so I think, I did a post about this yesterday. I was like, look, if you think inflation is here to stay, or that we're going to reaccelerate, if you think yields are going to go up, if you think the Fed is going to continue to hold and continue to tighten, just be long energy stocks. Stop complaining about the market and just be long energy stocks.
Yeah.
So, this is where you want to be if that's your thesis.
Yeah. And there's a lot of ways to play energy right now. You have the oil and gas names, you have the coal stocks. We don't have them in this presentation because I just did a video on them, but the uranium stocks are doing pretty well too. So lots of different ways to get exposure to the trend.
Yeah.
And
here's rates. right on time. Here's rates.
Yeah. So yeah, I kind of structured this in a way so we'd have some natural segues. So since we discussed everything so far, it's a lot of the conversation has been around energy and inflation. It's only right that we bring up interest rates. And so here we have the 10-year. This is a chart I've shared before. So we had this big run up, and when interest rates were rising for last year, stocks really didn't like it. You can see it down here, but it wasn't when stocks bottomed in October, or excuse me, when rates bottomed. When rates topped, it was the same time that stocks bottomed. So stocks have done well lately because rates have not broken out to new highs. They're just sort of trading in this range bound consolidation. But the concern is if we break out to the upside, what could potentially happen. So what are you seeing here?
Yeah, I mean, this is bullish price structure for yields. If you want to say it that way. The Fed is still tightening. Yield should continue to have tailwinds to rise. They're still doing balance sheet runoff. They're still draining liquidity out of the markets. And so in a lot of ways, yield structurally should have tailwinds to keep rising. The funny thing is just that the bond market is a forward-looking pricing mechanism, the same way that equities are, right? So like you can see that equities bottomed even before yields peaked because the equity market was seeing through the price action in the bond market, right? In a lot of ways. And I think, people have kind of been talking about it a lot this year, is that the retail investors in a lot of ways over the course of the past year basically have been the smart money. And so, typically the bond market is considered smart money and the equity investors are considered, the chumps at the table, maybe, if you will. But I think that role is kind of reversed here, so I'm not sure exactly how this is going to shake out. I was on the show with JC and Straza the other day, yesterday, and they basically asked me, like, is the 10-year going to get to 5.25 or 2.75% first? And I took the 2.75. So I think for me, structurally, I want to be, leaning towards being long bonds, but at the same time, I'm not in a rush to build that position in long-term portfolios, is how I'm seeing it.
Well, it's not just the 10-year that's rising. It looks potentially constructive. When we look at the 30-year, we can see a similar picture. So this is the 30-year yield on the US Treasury. You could see that it put in this basing action. We broke that downtrend that we had been in since the fall of 2021, which is just so happens to be when stocks bottomed out, was right around the same time yields topped out. So the reason I'm sharing this chart in addition to the 10-year is we're starting to see some constructive action. So we're broken out of that little base. And, what are you seeing here? Do you have just, similar thoughts about the 30-year as you do the 10-year? They're both, looking potentially bullish as in pointing to higher rates, but we haven't had that big breakout just yet, at least breakout to new highs. So what are you seeing here?
Yeah, I think that's the key. If we get the big breakout to new highs, very similar to what happened in basically September and October of last year, right, to get us to that final push above 3 and 4%, then we can have that same, potential kind of tailwinds here for yields to keep pushing higher. But, until we get that breakout, as far as I'm concerned, those October, November highs are resistance. So yes, we do have this descending trend line breakout. I think the only pushback that I would give on this is if you look at those other kind of peaks between October and now, when we've had those breakouts over those resistance trend lines, it hasn't really given us that full follow through. So maybe it's just needed more time to digest. That's a fair argument to make. And, so we could get that breakout, right? But, I'm still waiting to see it. That's the big thing for me.
Yeah, and there's something to point out here. So I drew this diagonal trend line on here just to kind of, indicate a trend. So just the viewer could kind of, know what I'm potentially seeing here. But diagonal trend lines like this are, it's more subjective. So
Right.
the real trend line to watch would be the horizontal trend line up here, which would be taking out those October highs. So we haven't done that yet. So this could just be, all chop within a range. It doesn't really mean anything until we break out to new highs, in my opinion. But as has been kind of a theme of this discussion today, I think one thing both you and I do is we to get a message about what rates might do or what inflation might do. We like to look at a lot of different things, and the reason we're looking at growth stocks here is these are especially sensitive to interest rates. So if we if we have a concern that rates are going to climb higher, we would also potentially see some weakness in growth stocks. So we're looking at ARK here. This is a chart that Caleb sent over. And is that how kind of you're thinking about it as well? Are you kind of watching growth stocks and seeing if if they break down, if that could potentially coincide with a bigger move in rates? Is that kind of how you're thinking about this?
Yes and no, actually, right? So I want to focus here on what we're seeing basically in May here on this ARK chart, where we basically hit that bottom and we went from basically 34 all the way up to 50. If you wouldn't mind, Justin, if we could go back to that chart on the 30-year, look at what the 30-year was doing since May. It's been moving pretty substantially higher, right? Yeah. So we've seen growth stocks and equities, more broadly speaking, participate in the upside, even in a rising interest rate environment, which is pretty interesting to me. So we could go back to the ARK chart now really quick. So we're essentially getting a structural breakdown below those former year-to-date highs that went back to February 2nd of this year. You can see it acted as resistance in June, even into July, until we finally got that breakout. I was hoping we were going to catch support there. We haven't. It looks like, though, this 200-day exponential moving average is providing some pretty significant alpha. Perfect resistance on those February highs. We got the breakout in June, flipped it back into support in June, and now we're retesting it for the first time in basically 2 months. So look, if we've broken below that structural gray zone, if we break below this 200-day EMA, then in my opinion, this kind of speculative bucket of innovation companies is off the list. But hey, we might catch bids here on this 200-day EMA.
Yeah, definitely. And one thing that all I'm personally doing is I'm watching ARK the same way Caleb is, but I have a watch list of growth stocks, names that I've traded or wanted to trade the past few months. So the thing I'm kind of watching there, I'll go through that and I'll look at it basically every day when I'm trading and just looking for subtle signs of leadership starting to emerge. And I think you are kind of starting to see that. It's too early to anoint any leaders just yet. But I think if ARK's going to turn around, you're going to start to see subtle signs of that in individual growth stocks first. You don't just want one, you don't just want a single outlier, but if you can start to see certain growth stocks holding key levels, I think that will just be bullish for the overall bucket of speculative growth stocks. So that's something I'm watching, as well as just the price action of ARK. But yep. in addition to ARK, this is ARKF. This is the FinTech Innovation ETF, Kathy's FinTech Innovation. I think it's got do you know some of the names in there?
Yeah, they got Coinbase,
stocks,
Shopify,
Coinbase, yeah,
Robinhood, DraftKings. I think I mentioned Shopify already. They have Adyen in there. They have some names in there that don't necessarily seem exactly like FinTech, but basically like payment platforms. So
yeah. So what was interesting about this one is when growth stocks were starting to bottom. I wasn't the only one, but I was looking at ARKF. I was looking through the different Kathy's different funds, and ARKF was showing even more strength than ARK. So maybe it'll play out similar to how it played out a few months ago when these growth stocks were just starting to break out. Maybe we'll start to see ARKF, which has been shown relative strength versus the ARK flagship fund. Maybe we'll start to see signs that that's bottoming out first. And you have this wick-off accumulation pattern. Is that a scenario that you're watching here?
100%. So, the ARKF is showing significantly more strength than ARKK, right? The flagship innovation ETF. So here you could see we're still trading above those former year-to-date highs, whereas ARKK has broken down. Mm-hmm. And the main differential here is that ARKF is actually hitting new 52-week highs, whereas ARKK couldn't even break above those August of 2022 highs. So for me, it looks like potentially ARKF has left the station. And in this kind of Wyckoff accumulation, now we go into that final extension, continuation, bear market reversal phase, right? So this is kind of the final stop en route to that full-on bull market uptrend only type of environment. I could be wrong on that thesis. So if we fall below those February of 2023 highs, I would cut a position here. I'm not in ARKF, but I'm trading coin as a gauge for this type of setup because the coin structure for me still looks very good. I was buying that even today, initiated the position on Monday. And so this is something I'm continuing to add into because to me, ARKF still looks quite strong, very strong, in fact.
Yeah, it looks pretty good here. I'm just, narratives aside, and like everything we've discussed so far, there's inflation's come down, but there might be people who are talking about inflation coming up because of what we're seeing in commodity prices. But if you were to put all that aside and you just looked at this chart here, it just looks like a pretty routine pullback so far. So no reason to panic or anything here. And to kind of go back to what we said about ARK, ARK's pulled back and has been the weaker of the two funds we're looking at here. But I think it's honestly more important to watch the performance for ARKF because it has been the stronger name. So I think you get a little bit more concerned if you start to see leaders, and I know this is an individual stock, but leading groups start to break key levels. I think that could be for me. I would interpret that as a bigger red flag than just seeing a relative laggard pullback and maybe not respect some support lines. But I don't think we can end this conversation without a discussion of large cap growth. So we've spent a lot of time, a decent amount of time talking about the small cap stuff, the more speculative ARK names, but a lot of people have exposure to these mega cap growth stocks. So what are you seeing here?
So with MGK, when we broke to new year-to-date highs in April, I said so long as we stay above those February highs, we can stay long. So that's that lowest green box there on the chart. Sure enough, we flipped it into sport. We kept hitting new year-to-date highs until we started hitting those August of 2022 highs, right? That big pivot level. You can see we cooled off there for about 3 or 4 trading sessions until we broke out to new 52-week highs. When that happened, I said, so long as MGK, which is MegaCap Growth, so long as it stays above that middle green level, you can stay long MegaCap Growth. Where do we go next? We went all the way to those March of 2022 highs, right? Just before that final leg lower in a lot of ways. And we attempted to break out above it. And I said the same thing. So long as we stay above those March of 2022 highs, we can stay bullish. And what's happened? I put the big whoops on there, right? I'm taking that from the guys over at All Star Charts who put that whoopsie on there. And so we have a failed breakout here and we're rolling over. So for me, structurally, this is off limits, right? So tech still looks okay to me, but mega cap growth in and of itself is pretty much off the list at this point.
Oh, yeah, I would agree 100% with you. I'm not exactly sure what's in this fund, but as far I look at a similar chart to just get an idea of how the mega caps are doing. I look at the FANG Plus index, which has got like Apple and Microsoft, Nvidia, Amazon's in there. I think Tesla's in there, and a few other names. And it's been relative to this chart is a little stronger because it got all the way up to those former all-time highs, but has since struggled in the same way that if you look at Microsoft on an individual basis, it got up to those prior all-time highs and had what All-Star Charts guys would say is a whoopsie moment or an oops moment where it had basically a false breakout, and you could maybe make the case that Apple's doing the same thing. I know we're going to look at Apple in a second, but yeah, I think I'm right there with you. I think if there's going to be within growth, there could also be, everyone's talking about the rotation from energy, potential rotation from energy or from tech stocks into energy stocks, but we could also see rotation out of the mega cap, large cap growth into smaller, more speculative names that are hadn't quite had that big run up yet, aren't as extended, and are still basically emerging out of these multi-month bases that they've been building. So that's definitely an area of the market I'm watching. I'm right there with you though. I'm more if I'm going to go growth, if I'm going to go tech, I'm going to go smaller.
Yeah,
mid cap, not mega cap. You want to move along? I think we got Apple here next, and so this was basically what I was had alluded to already. Apple had that big breakout, and I wouldn't quite rule it a false breakout yet. I'd be interested to hear your interpretation, but we had that big breakout, we pulled back, and now we're pulling back into a key level. So I think this is just a very important area for Apple right here. Are you seeing it pretty similar?
Yeah, exactly. So I was outlining this channel throughout 2022, saying and I was doing the same thing for Microsoft, and I was questioning what if it's all just one big bull flag, right?
Yeah.
And sure enough, we've gotten that breakout this year. Looks great. We've broken a new all-time highs. Looks great. Structurally, we're now retesting that former resistance range. It's a little bit wide. I think it goes from basically 175 to 185. But look, that's like a 7% range. It's really not that big in the grand scheme of things. And so for me, I just see so much bearish commentary around Apple right now. And I really do feel like, we were just talking about how I don't want to be long mega cap growth in this environment. I don't think that Apple is considered mega cap growth, right? Their revenues are contracting down 7% in the most recent quarter. The quarter before that was down 3% year over year. So this is not a growth stock in this environment, but it is a mega cap stock, right?
Yeah.
And so for me, again, this probably looks like, maybe even alongside something like Google, this looks like the most attractive name in that mega cap section, right? You had mentioned the NY FANG ETF as kind of a proxy for that. It's a great fund. I track the same thing. The difference between that and MGK, which is the fund that we were looking at earlier, is the NY FANG index is an equal weight basket of 10 large cap, mega cap tech stocks, right?
Yeah.
Whereas MGK, I think only 60% of that fund is allocated to, the Magnificent Seven or Fangman or whatever you want to call it. So
Yeah.
there's still like this 40% that's in like Visa and MasterCard and Salesforce and Intuit and those types of stocks that are still captured in that MGK fund. So, MGK might be off the list, but I don't think Apple should be.
Yeah. Interesting. Yeah, definitely not a company you want to bet against either.
That's right. Yeah,
Proven its
exactly.
doubters wrong the longest time. And kind of to circle back to what you said about Apple being a growth stock, I feel like there's just a lot of confusion about what kind of stock Apple is, but it is worth pointing out that I think isn't Apple about half of Berkshire, so
Yeah.
the world's greatest value investor basically has a super outsized bet on Apple. So yeah, I'd say that's a pretty good reason to consider Apple to be a value stock. But I don't know,
Yeah.
just
And I heard the stock's done quite well this year too. So
yeah. um. So the next one we want to look at is really staying on the topic of larger cap stocks, at least and how it influences this index. So this is the Nasdaq. I think, what does tech make up of on the Nasdaq? I posted about it recently. I think it's like 50% or 49%. It's more that it's significantly more than the S&P 500, but it's not a pure tech fund, but it has a lot of exposure to tech, and that's a big reason why it has performed so well. At least for until recently, the past month or so, we've had a little pullback, but the strong performances of big and mega cap tech has really aided the Nasdaq. And you could see here on Caleb's chart that we're pulling back into a support level after having that initial breakout. So yeah, I mean, what are you seeing here? You think this is a buyable opportunity on the Nasdaq right here?
I don't know if it's necessarily a buyable opportunity. I think it depends on your risk appetite, right? So I'm sharing another very similar chart on Twitter right now that's much tighter risk management because I think it's kind of necessary in this environment. And we're getting a breakdown below this range already, at least yesterday and today. So, perhaps some sign for caution, but this chart is a little bit looser risk management. So it gives us a little bit of a degree of flexibility, wider room for error, that, extra margin that we might need. And so, I like this chart. You could argue it's buyable depending on your risk appetite. Personally, I'd like to see a little bit of some signs here of some rebounding and curvature back upwards.
Yeah.
And then just to clarify for tech, right? I just looked at, the Qs. QQQ is 57% tech and then about 19% consumer discretionary. The thing is, like, what are they considering consumer discretionary? Apple, Amazon, and Tesla, right? Like those are tech stocks in the grand scheme of things, right? So like, I'm not sure exactly what they're doing to classify on this, right? It's kind of hard to tell, but I don't want to jump the gun here and just say, oh, tech, it's a failed breakout. I'm not there yet. I think we still need to see a little bit more of some decisive breakdowns here, and we haven't seen it.
Yeah, definitely a chart to keep an eye on, no matter if you own the Nasdaq outright through QQQ, but it's just made up of such big, important companies that even if you're more of a stock picker, the trajectory that those stocks take will have an impact, most likely have an impact on your portfolio as well. That might be it. I'm not sure. Yeah, I think that's it. But yeah, I mean, covered a lot of ground here, and yeah, that was a fun chat, man. I appreciate you coming on here and jamming with me, as you say.
Yeah, of course, dude. It's been a long time coming, like I said at the beginning here. So I'm glad it's a blast for me as well. So thanks for having me, bro. And we'll have to do it again sometime, 100%.
For sure, man. All right. Well, until next time, thanks everyone for tuning in.